So we've been talking about the fiscal reckoning for a year, and I think that's still what's happening is we're in the middle of it. So the reckoning is here, and the bottom line is I think that the government will cut spending or raise taxes by about 3% of GDP. And that's a big move. And that's causing austerity, and it's causing downward pressure on equity markets.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When markets are in turmoil as they are now, I often emphasize that the most useful people to interview are asset managers. Because they don't have the luxury of merely having an opinion on the road ahead, they have to commit capital to their convictions and be judged upon the results. Today we've got the great fortune of having the return appearance of one of the most respected capital allocators in the business, Jan vanEck. Jan is CEO of vanEck, an asset management firm with over $100 billion in assets under management, invested across a wide family of ETFs and funds, spanning equity, bonds, commodity, digital, and regional asset classes. As we've done the past several quarters now, Jan and I will spend the next hour discussing his latest macro and market outlooks, as well as where he sees the biggest opportunities for investors right now. Jan, thanks so much for joining us today.
I can't wait to dive into it, Adam.
Yeah, it's not like there's much to talk about, Jan, is it? No, a lot has happened, and right off the gate here, when you were on last time, I think I sort of asked you, to assess the mood of the markets, and you had said cloudy, and I think that for all the reasons why you said that, they've certainly been validated since then. So congratulations on making a good call.
Thank you. I got some of it right, some of it wrong, but I got the conclusion right, at least.
Exactly. Well, hey, look, that's all that really matters at the end of the day. So we're talking not even quite yet a week after Liberation Day, where President Trump really surprised everybody, not by putting tariffs on, as he said he was going to, but the calculations that he came up with and the severity of the quote unquote reciprocal tariffs that he slapped on pretty much every country out there, were much higher than many people expected. And the world is still reeling from that right now. So, I guess I'd love just any opening words you have on how that may have changed the game here. And I know as you have the past couple of times we've talked, you prepared a slide deck. When you're ready, let's just get straight into those.
Yeah, sure. I mean, look, I think the summary is that what we've been saying is that it's the first year after a presidential election, and every 4 years, that's when serious policy happens, fiscal policy primarily, and then the Fed reacts to that. And indeed, that's been happening. So we've been talking about the fiscal reckoning for a year, and I think that's still what's happening is we're in the middle of it. So the reckoning is here, and the bottom line is I think that the government will cut spending or raise taxes by about 3% of GDP. And that's a big move. And that's causing austerity, and it's causing downward pressure on equity markets. So that's the kind of summary of the presentation. But what I would love to do in the short time that we have is go through the details, because there's not a lot of information in the press, I think, about how we get to that number. And there are a lot of comments that I think need to be discounted. So I look forward to kind of sharing my analysis and getting your input and the input from listeners.
All right. Well, look, let's not beat around the bush. Let's just roll up our sleeves and dive right in.
Okay. So title, In the Middle of the Reckoning. And I guess that's very resonant. So let's just talk about my conclusions. Again, taking a big picture perspective on the markets, the most important thing that's been happening is the profligate spending by the federal government. Last year, it was about 6.5% of GDP were the government deficits. And, people were talking about the great America and America exceptionalism. And to me, that was just sort of a fake economy. And I mean that because it was because the government was stimulating so much. Of course, our growth was great. Of course, we didn't have a recession. Of course, interest rates stayed high. But we're switching paradigms. And that's really what I want to talk about. And I think we're switching paradigms in a major way. So that 3% of GDP cut means austerity, means recession. We also talk, of course, we have to talk about tariffs and how that reinforces my conclusion of my primary base outlook. And then, vanEck believes that there are multi-year trends that investors can take advantage of. And the ones that we've talked about before, gold continues to be good, and we'll talk about Bitcoin. But we were a little cautious on India in the fourth quarter, and I think now that's more attractive. I'll explain why. And last summer, we were bearish on semis, and I think that now prices have fallen to attractive levels there. So I'll give you some data to chew on. So I hate repeating slides, and the colleague said I shouldn't do this, but I just think that when you have a multi-decade slide, this is the type of macro perspective that we at vanEck love. And again, this just shows in the green line low unemployment, yet in the blue line high government budget deficit. And what we used to call that, Adam, is 2 feet on the gas, right? And I think we're now taking both feet off, but let's get into the meat of that. So last fiscal year, we spent $6.75 trillion. We took in 4.92 trillion in taxes, which is a deficit of 1.8 trillion. That's 6.4% of GDP. What I'm saying in my headline here is my base case is that will shrink by $1 trillion, which is about 3% of GDP. I will explain how I get to that $1 trillion. I will also say what I said when I was traveling overseas to India and Latin America over the last 2 weeks. Every time I say this, no one in Washington believes that we can cut $1 trillion. Like, if there are 8 people at the table, 7 of the 8 are disagreeing with me. And also, I would say it's very hard for people to kind of articulate how we get there. So let's do that.
All right. And Jan, I'm just curious, are you talking to anybody in your travels there in the Trump administration? Because obviously they're saying they're trying to cut the deficit by that or even more if they can.
Well, that is the disconnect, right? That is the cacophony. You have Elon Musk and administrative spokespeople and cabinet officials saying what I'm saying, but it's sort of like what Trump was saying with tariffs. But people are putting such a heavy discount on it, right? They just can't believe he wouldn't really do that, right? It's just a negotiation or he's pretending. And I will say this is almost a week after tariffs were announced, and he hasn't announced any changes to those tariffs, but I will apply a discount to what the headline number was last week. So I guess all of us are applying discounts. It's just how reasonable they are. But you're right, at face value, it's a lot of money. So fog and confusion. So my base case is right here. I guess I call it the high case, but it is my base case in the middle of the deck, where 2 million jobs are lost, and that is about valued at $125,000 per employee, which is about $250 billion. The 125 per person includes benefits, so it's fully loaded. Now, how do I get to 2 million? If I go to the first bullet, people say, well, there's no way they can fire 2 million people because there's only 3 million federal employees. Well, that's true. But if they have terminated 200,000 so far, and 75,000 have accepted voluntary terminations. So we're almost 75, sorry, let me clarify. 400,000 of my 2 million is directly from federal employees. Okay, so we're 275 on the way to 400,000 government employees. A little more than a 10% layoff of the workforce. What no one has any data on, Adam, I mean, maybe one of your guests does, I just can't find anything. Anytime I Google it, is how many contractors are effectively paid for a full-time basis by the federal government. And you've heard, a range from 5 million to 20 million. So some radical multiple of the number of direct employees. So of my 2 million employees, I'm saying 400,000 directly from the government and 1.6 million from that contractor base. But
Oh, yeah.
again, it's an educated guess. I have no, other than, podcast interviews, I really don't have a lot of support for this. So that's why I'm cutting that by half. So I'm just assuming, I really think that's what's going to happen, but I'll apply some kind of discount and call that 125 billion. And let me just explain where that fits in. So here's kind of, I call it 875, but let's call it close to a trillion. So 125 billion is from the layoffs, the 2 million layoffs that I just mentioned. Then I'll call 100 billion waste, fraud, and abuse. Now, Doge already says that they've saved 140 billion, right? But that includes both employees and waste, fraud, and abuse. So if you want to call it that way, they're halfway to my total number.
Okay.
Now, of course, they're saying it's $1 trillion, Adam, right? To your point. So
Right.
Jan is discounting these, but
Right. And they're only, what, not even 90 days in yet. So presumably they're going to make a fair amount more progress too.
they
Yeah.
say what 4 billion a day. But and what I really encourage everyone to do is write your own numbers. I left the right side blank. Write in your own numbers, right? Because I just think not enough people are kind of fleshing out their assumptions here.
Hmm.
So my tariff increase is a quarter of a trillion. Now in 2024, right, the base year that I gave before, I think there's something like 78 billion in revenue from tariffs. So this is 250 on top of that 78 billion. The numbers that came out last week were estimates vary, but somewhere between 600 and 800 billion dollars. So this is again a big discount to the numbers that came out last week. I'll pause there and see if you have any questions.
Yep. Nope. Nope. Keep going. I'm following.
Okay, so then there are a couple of Biden programs, the Inflation Reduction Act, 65 billion, that's gone. Biden increased Medicaid, not Medicare or Social Security, but Medicaid spending by 200 billion. That's gone. I mean, the House has already indicated that they're going to eliminate that. They're talking about different corporate tax increases, tax on stock buybacks. It's here in the kind of large font a footnote here, but business salt. I don't know, the IRA is mentioned twice, but anyway, so they're going to raise some corporate taxes. They say they're going to cut 10% of Pentagon spending, which is 80 billion. So that's how I get there. And I don't think this is a heroic assumption.
No, and actually you don't have Health and Human Services or Social Security there, which, Trump has said we're not gonna cut anyone's payments, but there's still a lot of potential waste, fraud, and abuse there. And maybe you're catching that already in the waste and fraud above, but you talk to Elon and his team, it sounds like they think that there's a target-rich environment there. So I would call your numbers definitely sane, maybe even kind of conservative.
Compared to what they say, absolutely.
Yeah.
And I did have a slide here just for amusement. If you want to see where hiring has happened in the last 5 years, you can see a lot in healthcare.
Hmm.
Some of that is through state governments and Medicaid kind of programs, and then you see consultants, and then leisure, construction, and manufacturing. So I would imagine the contractor numbers are in the healthcare and consulting. Well, I know they're in some of the consulting numbers.
Yeah. Yeah. And as I've talked about with other folks in this channel, if you looked at job growth over the past several years, um, it's basically all the heavy lifting's been done by government hiring. The actual private sector job count has actually decreased over years. So to your point, the main point you're making here, Jan, what happens when you turn off that spigot, right?
Yeah, I mean, people say, look, we're just resetting to 2019. When I'm feisty, I call it fake recent growth,
Hmm.
right? But anyway, there's different ways to look at it. So we've got
Hey,
that. Yeah.
can I ask you one question about your list here? So one thing that's not in your list, sorry, but your numbers on getting to your 1 trillion. Um, So working against this potentially would be tax cuts, right? How much of an offset could that be?
Okay, so the big tax cuts, right? The cuts that Trump did in his first administration were in effect in the last fiscal year, in fiscal
Hmm.
2024. So I'm assuming those are just continued.
We just roll them over, right?
Right. So
But
that's why they're not in this number. But you're right, that's a huge number, right? I think it's like four trillion or something over a decade or some large number.
yeah,
Then
but
you
now they're
take,
trying to get some additional tax cuts on top of that, right? You know,
well, you
the
have like wage tips, right? The tax on tips. Kind
tips
of,
and Social Security and overtime, and he wants to try to hopefully nobody over making under 150,000 ultimately would have to pay tax. I mean, we'll see what comes out there, but
it's yeah, I mean, if they want to do this through reconciliation, they can't play around too much. But and like the tax on tips, like that was sort of estimated to be less than 20 billion. And I know that sounds like a huge number, but anything kind of less than that, I left off
okay,
of this list.
okay, kind of
Just
rounding
like
errors here, yeah,
there's so many, different things that can be added in.
okay. And you're being so conservative here that I'm with you. A trillion is totally doable.
Okay, awesome. Now, just to talk about tariffs, again, my tariff number is probably a third of what was announced last week.
Hmm.
Of course, that's short-term inflationary, but it itself is contractionary, right? That's the headline. And the whole point of cutting fiscal spending is it's contractionary. And listen, the politics around this are shove it all into the first year. If it's going to be detox, according to Besant, or even a recession, as Trump himself said, it should happen in 25. So that, when you get to the midterms, the economy has moved beyond it.
Right, we're hopefully digging out by then, showing some upward momentum.
And the economy is coming into this very strong. So that's another, we'll talk about that.
Yeah.
I just like to make, to show how people don't believe me at all. So here, you just see this is a Deutsche Bank estimate, not to pick on them, but they're only estimate a cut from 6.5% of GDP to 5.5% of GDP as their best case,
Okay.
right? And I think part of discussing future investment scenarios is you really want the broadest set of potential outcomes. Like even if you put a very small percentage shot at it. So anyway, obviously, so I think it goes up here to the 3.5% level as my best case. Um,
Okay. And
then,
I'm sure you get here, but if that happens, I mean, Wall Street's going to have to do a massive repricing, right?
well, so look, this is the very difficult thing, and in a way, like I said last quarter, our base case is people, if they should just stay invested in a diversified portfolio, it's really hard to time these things.
Hmm.
And especially with tariffs, I think it just reminds us like you don't know what day necessarily it's going to hit and when the market is going to price this in. So I'm going to say we're in the middle of the reckoning. It's not over. I don't think you can, if you're going to buy on quote unquote dips, I wouldn't buy all now, right? That's the really bottom line. Stay invested, but this is not an overnight thing. I think it's a process thing
Hmm.
where the market starts to absorb all the details around this. Um, so anyway, I'd love to get your perspective if it's different, but that's kind of my thoughts, Adam.
No, no, no. And again, this I keep interjecting here. Let me let you run because I want to make sure we get your full thinking here on the screen for folks.
No, I mean, look, so just as I said, the headline 3% of GDP in the contraction of fiscal spending would not even get us to normal, right? So if you look here, this is the federal government percentage of revenue, again, the multi-decade chart, which I'm a sucker for. 18% of our economy's GDP has been collected by the federal government, kind of regardless of what happens to taxes over the last 40 years. Uh, Spending is what has changed, right? And we
Yeah.
have had several spikes, but cutting 3% from 24.9 brings us to 21.9, which is just kind of the average of the last several decades. So all you could say that the Trump administration would be normalizing federal government spending.
Um,
So
which kind of gives you a sense of how deviated we are right now or have been.
absolutely, and that's why I've been talking about so much in my outlooks, because I think it's the overwhelming fact. And hopefully in 6 months we'll be talking about something more interesting,
Yeah,
right, than federal
but
government spending.
it's really important though because it's the baseline effect, right? Where when you keep 2 feet on the gas for long enough, everybody begins to assume that's normal, right? And you basically are saying everybody got accustomed and addicted to a very abnormal point in history, and so the mean reversion is not going to feel good because you've gotten so accustomed to the old way of doing it.
Yeah. So let's talk about sort of just the bottom line here. So 2 million in job losses, 3% of GDP. That is flat out recessionary, right? You ask a college freshman taking macroeconomics,
Mm-hmm.
3% of GDP is a huge hit. I mean, I don't know if it's ever been done before in the U.S., to be honest, except for after wartime and things like that. But
Yeah.
now let's talk about how much this will affect the economy. So some of the government spending, so the theory is government spending can be good for growth because it has a quote unquote multiplier effect, right? So it's not just the government spending, but those people then spend money and sort of like you're boosting the economy or the
Right.
economic growth. Like 1% of government spending will result in like 2% of GDP growth.
Right. Because they hire contractors and then contractors go out and buy coffee on the way to work. Yeah.
Exactly.
Yeah.
Excuse me. Um, I I I don't think that a lot of this spending really has much of a multiplier effect at all. So let's take the extreme example, kind of some of the USAID spending in
Mm-hmm.
Africa or the Middle East clearly had no impact on the US economy,
U.S. economy. Absolutely.
to take the extreme. Now,
Yeah.
I don't mean to be an overly cynical New Yorker, but I know from personal experience that if people are not going to the office, right, which federal employees weren't, some of those people were having second jobs. So I'm not sure 2 million in job losses technically translates into 2 million people added to the unemployment rolls.
Yeah. That's a good
Okay,
point.
I don't want to be overly cynical, but I'll let people come up with their own numbers, but it's not one for one.
Yeah.
Now, let's talk about what will happen over the next several months. We're going to have corporate earnings coming out, kind of over the next several weeks. And people are going to say, well, Q1 was great. We made X amount of money, but I have no idea what's happening going forward. And some companies, like consulting companies or software companies that have lost government contracts, are going to basically be announcing bad news. We also haven't seen any kind of cadence of bad unemployment numbers. I can't imagine that we cut 3% of GDP without unemployment ticking up. Now, it may only tick up to 4.5% or 5%, but those are like headlines to come if this scenario is right, and
Yep.
people will be wringing their hands. Um, and I just think, Adam, that will lead to, again, hard to time, but downward pressure on equities. Um, the good news is, and we've talked about this before, is that lower growth will lower inflation and will allow the Fed to cut rates. So I'm going to put a number on it, 200 basis points this year.
This year. Okay. And you know who would love that the most is President Trump.
Well, that helps homeowners and it helps a lot of people.
Mm-hmm.
So what do we see in the financial markets? And a lot's happened in the last couple of days. So I wanted to include that data, Adam. High yield spread. So this is companies, money borrowed by companies that are, call it, less on the riskier side of the spectrum. And how much did they have to pay to borrow money? And you can see here, it's gone up in the last couple of weeks. This is updated as of April 4th, but really it's just a normalization from extreme levels, right? So nothing to really worry about. And then I like to look at the cost of ensuring the payment of U.S. debt. You can see that's ticked up, interestingly, but nothing crazy so far. So I do like to point out, like I did say, that inflation would come down. So a lot of the inflation is in services, not in goods. So it can't just be lower gas prices with greater Saudi production. We do have to see some of this trickling down into the real economy.
Mm-hmm.
So anyway, so this is basically the last inflation chart. So hopefully this will fall. So that's the story, if you will, around how I think the markets, the primary narrative around the markets, the equity markets facing downward pressure. And of course, I haven't showed a chart of the 10-year, but the 10-year is 100% reflecting a cut in spending and the slowdown in the economy.
Got it. So a couple quick questions here. One, you say inflation risk is still a concern. Obviously, the whole tariff palooza from last week has a lot of people screaming, oh my gosh, inflation's going to scream because prices of everything are going to be higher going forward. How much of a factor, if any, do you think that's going to be?
So again, my budget number was 250 billion, right? Which is about a third of what was announced last week. I definitely think we don't have like an official inflation forecast. I think it'll be a one-time thing anyway. And so I'm not overly worried about that overwhelming the whole thing. But you're right, that's definitely a risk to this scenario, which is that the slowdown in the economy or a recession, if it becomes a recession, stays longer because the Fed doesn't have the ability to cut rates. But I think there's no question we arrive at the station, Adam. It's just there's traffic on the way there, or there's a slowdown on the way there. So it's not a kind of permanent stagflation crisis cycle that we had in the 1970s. This would be my estimate. It's more of a one-time shock that takes a while to work its way through the system, and then we can't really adjust as fast maybe as we would like.
Okay, got it. And that's where I was going with the question.
Because I think, sorry, you didn't say it explicitly, but I think you're 1,000% right. The Fed needs the political cover of lower inflation to cut rates.
Yeah.
100%.
Yeah. And I'm wondering, we're seeing some signals of potential coming deflation. You talked about the 10-year, but oil, its price has gotten whacked. Copper has been getting beat up. So, are these things that start to provide some initial air cover, do you think?
I think they help. And obviously it depends on the inflation statistic that you're looking at. But again, goods inflation hasn't really, it did tick up at the end of last year. And it definitely is not, it wasn't helpful that those things were rallying. But I think they'll go sideways from here.
Okay. And last question sort of on, and I'm asking you to totally guess here, but how if a recession does manifest on the timeline that you think it will, how prolonged of one do you think it's going to be? I think people, recent memory, COVID, oh, it was a blink and you miss it recession, right? And it's been so long since we've had a prolonged one. Is this one going to be more protracted or not?
Wow, that's a great question. And it's almost a whole separate hour of discussion. So what I would say is that prior recessions typically happened in we had an agricultural economy and then we had a manufacturing economy. And it was much easier to have recessions in both of those than in this sort of tech-enabled services economy, right? Because in agriculture, there was oversupply, ag prices fell, and that would be devastating for the farm economy. And then in a manufacturing setting without computerization, there was overbuilding of inventories and blah, 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 blah. I don't think we're in a kind of recession-free services economy, because the one risk that I would say is how much activity is tied to the stock market itself, right? It's kind of like a reflexive thing. So, if you want to say the wealthier consumers how much do they cut back on their spending because their 401ks and their private bank accounts are contracting significantly. So it's a little bit of a cyclical thing, and I don't think we've ever lived through it, Adam. So I think it's something we don't even know. But it's a great risk to put out there.
Okay, and I guess in that world, then what happens to the stock market is actually quite important because the negative wealth effect, if it were a big drop, would then reflexively make the recession worse.
Exactly.
Yeah.
Um, exactly, and longer, right? To your point. So don't know the answer. Good,
Okay.
really. But it's interesting. There are a bunch of different commentators with different views on this, but because we haven't been through it, it's hard to know.
All
Okay,
right.
so enough of that.
Mhm.
So, I mentioned at the top there are a bunch of tactical views that we have, so I just want to kind of share that. So I said, listen, we're bullish on gold and Bitcoin, big picture. Gold is part of demonetization trend. I've started to quote, the numbers when we started to get bullish. Gold was at 2,000. Now it's at 3,000. Bitcoin was at 28,000. Now it's around 80,000. So we still think the directionality is good, but I do think short term, gold is a little stretched. It's way above its 200-day moving average. Um, it's starting to make headlines all over the place.
Mhm.
Again, bullish. That's why I included the picture. But I'm not sure I'd be adding to it right now if I had a good gold position. It's the highest weight in our own portfolios that are allowed for risk purposes. So we're not selling, but anyway, I'm just pointing out that it's due for a little bit of a correction.
You're basically saying you really like it, but it's had a great ride in recent terms, and wouldn't surprise you if there's some cooling off period, a bit of a pullback, but you're still long. You're not changing your allocation.
And it's the best performing asset this year so far. And this is over a 1 year period, gold and gold stocks.
Yeah.
So, just to put it in perspective. Um, so let's just, if I could, just talk about Bitcoin a little bit because
Go
more
for
and
it.
more advisors and investors actually this year have actually engaged us to talk about it than before. And so this is sort of my general view is that if you're not an expert on digital assets, then don't start picking your own tokens and things like that. Please give your money to someone who really studies this full time. Um, like I've said, like when we launched our Ethereum ETF last summer, if you don't know Ethereum's market share, then do not buy this ETF. Anyway, so they think there's some interesting stats that I just want to share. First of all, if you go over every time period ending April, so I want to say that Bitcoin's down this year, something like 10 to 15%. So despite that, Bitcoin against the NASDAQ outperforms for every time period.
Hmm.
But despite the recent underperformance and Bitcoin hit all-time highs in Q1, it still beats it by well, you can read the chart massively over 10 years, but even year to date. So anyway, again, we're long-term bullish. Let me give you
Hey,
some.
sorry, can I ask you a question on that?
Sure.
So some people make the argument that gold is a safety asset, right? It's the anti-fiat trade. It's you want to be there when the world wants to run to safety. And obviously many Bitcoin proponents have said, hey, it's even better gold, right? It's gold 2.0 or whatever, right? But a number of people, especially in recent months before the market really started to sell off, but even during, have said, I don't know, Bitcoin seems like the most risk on of assets, right? And when speculative fever is running, Bitcoin runs the most. And so looking at this, it does seem to make a case that it's very positively correlated with the Nasdaq or
Well,
I guess
I'm glad we rehearsed these slides, Adam.
oh,
Uh,
good. Okay,
Guess
then go
what?
ahead. Oh, that's what this is. Yeah,
That's
makes
what
sense.
this is. So
The green is what I was just talking about, right?
this is an anti-Bitcoin slide, right? So what this basically shows, and I don't really like correlation as a statistic, but anyway, here it is. So I believe this is the 30-day correlation of Bitcoin against the NASDAQ. And it's to your point, if Bitcoin is only, and let's say 1% is perfect correlation, if Bitcoin is high on this chart, if it's highly correlated to NASDAQ, who needs Bitcoin? You can just own the NASDAQ,
Hmm.
right? And so the point of this chart is only to show that is a concern for Bitcoin investors because post-COVID, suddenly the correlation, I mean, it's not overwhelming. Okay, so overwhelming is like stocks correlate up here off the chart, like zero point
Yeah.
0.8, zero point 0.9 to each other. But it's much more positive in orientation post-COVID than it was throughout its history. So it's an interesting. I don't know. It's more traditional investors are involved, or exactly what's happening. But my takeaway is out of it that we do use Bitcoin in our portfolios, but you have to be active about it.
Okay. Um,
That's one chart. Let me show you my other chart. Because another statistic is volatility. So Bitcoin is the white line, and that's its volatility. It's still volatile. Obviously, the red line is the S&P. It's obviously become more volatile. Did something happen last week? Yes. Right. And then the blue line, I'm pretty sure, is the NASDAQ. I'm sorry, is gold.
Gold. Yeah.
Um, this is to your point, like, yes, Jan, that's very nice. I'd like to just keep owning my gold. Thank you. Um,
Well, if you're owning it as ballast, yes. Yeah.
but if you look at Bitcoin's volatility against the NASDAQ, it's become better behaved. So it's become less volatile on a relative basis against NASDAQ.
Yeah. But
So
as long as those positive correlations maintain, the less volatile it becomes. Does the argument of, well, I own Bitcoin and just own the NASDAQ get stronger?
I, I
Because
it's sort of like another dimension to the same argument, which
yeah,
is who needs it, or more importantly, I mean, I used to have this narrative that Bitcoin is an asset that's growing up, or putting in other words, it's like it's increasingly becoming mainstream as more and more investor types adopt it. And the question that we need to ask ourselves is its behavior changing now that there are ETFs available, right? Now that a lot of
right.
people have downloaded the Coinbase app and look at it amongst their other investments. I don't know, but I always like to put the positive side of an investment and the negative side. And I would say
Hmm.
this is the negative side. And maybe it's too wonky, but it's really, if you're talking to investors, it's the whole argument, do you need or do you want Bitcoin in your portfolio? And this is what I pointed out, like last year, that with the correlations higher, um, it's a worthwhile question and a question that allocators are going to be asking themselves.
Okay. Now I might be front running some of your other slides here, but so you said you guys are long gold and you're continuing to hold at your highest possible allocation right now, even though you expect some sort of short-term cooling off or pullback. You said Bitcoin, you still are long. I don't think I asked you yet the why on both of those. So what's the why that has you long-term optimistic about these two guys?
Yeah, I mean, these are both store of value assets, meaning their supply is relatively fixed in an uncertain world, and as contrasting to governments that likes to
Hmm.
print and print more money. The negative of that is that they don't generate income, right? Gold sitting there basically generates no income, and neither does Bitcoin, let's say, for argument's sake. So some investors just say, well, you never need to own anything like that. I'd way rather own equities. The argument is simply that investors have demand for these assets in an uncertain world. They want to hedge themselves. And gold in particular has gotten a bid, I think, because and we're going to talk about the growth of India, but the world is simply becoming less US centric. And the question then is, okay, if you want to own another currency besides the US dollar, what are you going to own? it's
Hmm.
going to be gold.
Yep. And
And
central
that,
banks are showing that they've been showing the way on that, right? The
yeah, we've
countries have been.
shown, I don't have the charts in here, but we've shown central bank buying, but also individual buying. And so central bank buying has been super high the last 3 years. Individual buying has been high. So it's just a world that gets wealthier over time, especially Asian countries, China, India, Southeast Asia. They're natural buyers of gold, just as a part of their normal portfolio diversification. So that is, and then when the US has seized like Russian assets, that in particular made a certain set of countries say, whoa, I want to own gold in my vaults. I do not want to own dollars held by a US bank when they can take that away from me at any point in time.
Yeah,
So,
yeah.
um,
And so it sounds like you think that obviously that move was a really important one, kind of a seminal moment for um, national reserve strategy. Oh gosh, we don't want to be that vulnerable. We got to buy something else. Okay, gold lets us do that. Um, do you
and the
also think that Liberation Day is sort of added fuel to the fire of just the US is just we don't know what they're going to do next, and so we got to find some way to be a little less dependent on them?
Absolutely. Absolutely. And what I was going to say as well is that gold has performed in a variety of US oriented economic situations. So when the dollar was strong, gold was actually doing well. When the dollar weakened, it's continued to make new highs, all-time highs. So interest rates were, rising and then they were falling, and gold still basically rallied, as we've been talking about for 2 straight years. So it's less US centric than it used to be, which is really the point of the asset.
Okay. And given that, if the world is, I mean, they're not going to give up on the U.S. Treasury in total for a long, long time, and hopefully never. But there's greater appetite for something besides treasuries to fulfill that same function, right? If we go into this recession that you think we will, if the markets do have a tougher time later on this year, and there is a safety trade, do you see gold as do you think capital will move to gold as part of a safety trade, or do you think gold might get dragged down for some reason? And maybe might the effect on the safety trade be a little bit more pronounced this time because people are a little bit less likely to run to treasuries for safety. They'd like to look for something else.
That's a great question. I let's come up for a name for this recession, and I'm going to call it a shallow recession.
Okay.
And so I think if it's an orderly market, which basically so far it's been, except for last Friday, and a shallow recession, I'm not sure that ends up being a big marginal adder or subtractor from gold demand. So I kind of think that these secular trends, again, may not be so affected by it may not be dominated by the US and what's happening.
Okay.
So that would be my base case, that gold could probably just rally right through that. But it's a
Okay.
great point. It really depends on how it plays out.
Let me ask you the similar question for Bitcoin. Recession, whatever severity of recession, do you expect Bitcoin to act as more of a safety trade, a flight to safety, or do you see it maintaining more of its speculation on steroids and therefore it would get more hurt along with the other speculative assets?
I'm still a core Bitcoiner, so I don't think it's just a substitute for the Nasdaq.
Hmm.
I'm pointing out the negatives on the
Yep.
side, but I'm not. That's not my kind of base case. My base case is it's an asset that will continue to be adopted, and we haven't even really seen institutions getting that involved in Bitcoin or governments. What you've seen actually interesting over the last year is a lot more corporates buying some Bitcoin for their balance sheets, which is
Yeah,
really
this is the Michael Saylor strategy, right?
not yeah, but not even but even Michael Saylor Light, and I never would have predicted that. Like GameStop and maybe GameStop, but right, some other companies. It's very very interesting. So no, I think it's just a general wealth demand for a store of value asset and diversification.
Okay. All right. Sorry, I'm sorry to have interjected with so many questions here, but the problem is you keep throwing up these fascinating charts.
Well, anyway, so that's where we're on Bitcoin. The cautionary tale I just want to interject, right, is if you believe in the halvening cycle, you 2026 will be a bad year for Bitcoin. So anyway, we'll see. We'll see. We can talk about that when we get there. But
Okay, but if it does prove to be, I'm assuming you would say that that's pretty good, opens a pretty good entry point or accumulation point for the long-term Bitcoin investor, correct?
and it'll probably be a little bit less volatile than prior corrections.
Okay.
But let's anyway. So tactical play or tactical ad number one was is gold and Bitcoin. Okay. Next, let's talk about semiconductors and technology. So just to really quickly recap, last summer we saw this multi-decade chart that showed that growth was as overvalued or valued against value stocks
Hmm.
as the internet bubble, right? And last July, wherever that slide is, but anyway, last July, we basically said try to be cautious on growth. And that was also reflected in the fact that the ratio of the S&P equal weight bottomed here around the internet bubble, and it also bottomed in 2024. It says 23, but it's a big chart. Okay, so we said lighten up on technology. Just to interject, since then we've been going to what vanEck calls phase two of AI, which means the first phase was sort of like just buy NVIDIA blindly, and now other things are happening. The rest of the S&P is starting to adapt AI technology, so it will spread throughout the stock market. NVIDIA has competitors, even it
Hmm.
competes against its older chips, as DeepSeek pointed out. But it will be driving energy demand for nuclear and natural gas. Okay, so that's what's happening in the cycle fundamentally. And since we said sell tech, the Nasdaq, just keeping score, has dramatically underperformed the Dow over that time period.
All right.
Okay,
Congrats
so,
on your call.
well, whatever. Anyway, so but now you look at NVIDIA forward earnings, and they're down to 20 times, right? So NVIDIA's earnings have kept growing. Its price has contracted about a third. Now, I hate to say this is not a bad stock.
Not a bad stock. And I think, I don't know what the forward PE, the average forward PE of the S&P is, but I think it
No,
might be
no.
higher.
Oh yeah, of the S&P. No, the S&P I think has fallen, but same ballpark, right? Same ballpark.
Yeah.
So wow, you know, um,
Quote unquote, best value it's been in at least 5 years.
years. And so basically that happened, right, Adam? That happened in what, 8 months, 9 months?
Hmm. Yeah.
9 months. And the market, as we said, it was very distorted. And so now the overall market is normalizing, right? The Mag 7 have come down, and it's sort of it's sort of that's what happens when you have multi-decade charts and they say, wow, it's never been like this. It's unlikely to persist,
Hmm.
right? That's why I love those multi-decade charts. And speaking of a lot of time, let's change topics. Are we allowed to discuss uncomfortable things like international investing on this podcast?
Absolutely. And, last time you were on, there were a couple of markets you were real big fans of. I think Brazil was one, but India was definitely at the top of your list. So very curious to hear what you think about them, but also what impact, if any, Liberation Day and this whole new tariff regime, might have on the international stage.
Yep. So let's see if I got this. So first, let's just set people care about performance. So year to date, Europe in the dark blue has way outperformed the S&P, right? And people thought, oh, we didn't know international stocks could actually go up. Now everything came down recently, but basically that's the news of the year.
Right.
That now the S&P is not the princess at the ball anymore.
Right.
Okay, so
And Jan, sorry to interrupt, but I want to tie it back to your first trend. Um, is that largely because Europe finally decided that, we're gonna start, you know, uh, picking up the baton from the spending that America was doing. And so they've announced all this new increased deficit spending. And as you said, deficit spending puts the 2 feet on the gas, and we're beginning to see that happen in their equity markets.
Yeah, I mean, great point, and I wish I had made this earlier. The reason I kind of think US shallow recession is the good news is even though the US economy is slowing down, Europe is stimulating and growing. And I hate to, this sounds odd, but it's true. And China is stimulating in a
Yeah.
significant way, right? I mean, tariffs will change the conversation a little bit, but tariffs aside, that's nice for the world, right? That since the US is slowing, the other major regions are growing.
All right. So the baton is being passed, and they will pick up at least part of the US's slack.
And that'll be reflected in financial markets, right?
Got it.
And
Yep.
then going back to this slide, it's just, what we were showing is just in different eras, you can see how the S&P can thrive, go nowhere, and thrive, right? Without focusing on the particular years. Interestingly, equal weight is more consistent performer during different economic regimes, which kind of makes sense. But the point here, and these numbers have actually changed a little bit, but if you look at emerging markets, again, you can see given different regimes, you can have dramatically different performance. And it's a little bit less true for it's a lot less true, I should say, for developed markets, as you can see in these different regimes,
Mm-hmm.
but it's still true. And so I think our base case is that we are in a new regime where international will outperform the S&P. So like, let's call it like the 2000s. In any case, as you look at your portfolio, if you were underweight, as a lot of investors have been over the last decade, this
Mm-hmm.
is the time to reconsider it. That's our view. Now,
Okay.
let's look at international again in a slightly different context. So we have the S&P, which is the blue line. In the purple line, we have non-US stocks, and then we have emerging markets. And so this is sort of the same, background that we went into the year, which is don't bother me with international, don't bother me with EM. The US is perfect or good enough, right? And then you brought up my favorite country, and we're going to be talking about this country for many years to come, Adam, which is India. And in December, I mentioned that India was a little frothy. India has corrected beautifully. And I think that, for long-term investors, even though valuations are high, and I'll share that in a second, great time to look at India. And now you can see that India has actually outperformed the US, which, doesn't mean anything on a forward-looking basis. But I will just say, as I mentioned to you, I was there for a solid week recently. And, the macro story is as strong as it looks from afar.
Great. And hey, I should have asked this earlier. vanEck, is famous for its ETFs for all sorts of different asset classes, and you've certainly got them for gold and Bitcoin. Does vanEck have an India specific ETF as well?
We have two. We have a growth-oriented one, and then we have kind of tech leaders. It's called DGIN, Digital India, DGIN. So there are definitely ways to get access, and I can go through the details on those maybe at some other point. But
Okay.
sorry.
I just want to make sure folks who are inspired by what you're saying know that there are actionable instruments out there that they can look into.
Yeah, there are a number of good ETFs. I would say, and there are a number of competitors. So this is not a dig at anything, but I do believe we should look beyond the index, look beyond the MSCI. So Wisdom Tree has a good India ETF. There are a number of good India-oriented ETFs, but it's a huge equity market, Adam. Like literally, we could do a drill down just on India. There are thousands of stocks. There have been between 200 and 400 companies going public every year. It's a really strong equity culture. So it's a whole topic in and of itself.
On that, if you don't mind, Jan, folks watching, if you'd be interested in, say, like a special webinar on investing in India, Jan, if demand is high enough, is that something you'd ever be interested in doing sometime?
Oh yeah. I mean, I would certainly want to bring in some experts, but like that's would love to do that.
All right, well, that would be excellent. I don't want to bother you unless there's enough demand here from the audience. But folks, let us know in the comment section below whether you're interested in something like that or not. And if there's enough, then I'll reach back out to you on and see if we can set something up for later this year.
Great. This is just a simpler chart of the same thing. India outperforming the S&P. Valuations, again, cautionary tale. These are not cheap stocks. Some of the froth has come up, but not as much as you'd expect. But again, earnings and the economy are growing. What happened last year basically was that there was a sort of slowdown after the big election. You know, when Modi didn't get the full majority and he had to
Hmm.
power share, and there was just and the markets were overheated. So we have that. Um, I've got some charts on international. So just in a big picture, by international, I would say, I certainly like India long term, and I think there's a reasonable time to add. I just like to look at by comparison, where other countries stand because I'm starting to think more of the world by country rather than, just some big index.
Yep.
Um, and the two extremes I would say are the most hated investment. So people always ask you, "What's your absolutely most hated investment?" And that's definitely Brazil. Effectively, it was really you're getting 10 to 11% yield, Adam, on the bonds with only 4% inflation, and the stocks are just dirt cheap. I mean, well under 10 times earnings.
That's an amazing real yield.
And people like that last year, and the currency just went down. And like no now it's so hated people won't even talk about it. So anyway, no one else is talking about it. I would say that obviously Brazil and Peru and Chile and a number of LATAM countries have a lot of beta to commodities. Since those commodities have corrected recently, that risk is out of those positions. So something to look at. The reason I mention it is sometimes charts like this actually excite me. So meaning like Brazil going totally sideways, because I feel like my downside is relatively limited. It's sort of what
Yeah.
China did. If you look at last summer, that's when you wanted to buy China. It's sort of at these multi-decade levels. And it's like, okay, they're hated, but what's the downside? So
Right.
I've got like
Once
a
you're on the
little
floor, not much lower you can go.
I've got a little bucket in my portfolio for, hated things where I feel like there's no downside and I can't articulate the upside. But sometimes good news just comes along.
Okay. So, yeah, let me ask you this. To people who are saying, wait a minute, Jan, I mean, Trump basically just declared, trade war on everybody going forward from here. Isn't that going to really put the squeeze on a lot of international countries and India, China, these are some of the bigger countries, and maybe they'll be able to withstand or outgrow, some of these tariff challenges. But you said you're now thinking of the rest of specific countries and not just an ex-US basket. Do you have to be much more judicious and discerning kind of post-Liberation Day going forward, or do you not think it's that big of a deal?
Um, I can't get away from my true love, which is India. So the Indian economy, it just really has nothing to do with the United States economy. It's the huge, so backdrop, right? In 10 years, India is as big as continental Europe. There's four mega consumer markets in the world: US, Europe, China, and India is emerging. It's still extremely, someone on my trip said it's gone from being extremely poor just to very poor. It's a
Hmm.
very poor country, right? But their middle class is growing. And beyond that, they have a great equity culture and a great technology base. I mean, so many global companies have their tech operations in India,
In India.
right?
And their population is now bigger than China's, right? They did surpass China?
Yes, yes. But again, a lot is extremely poor, but still. So, um, my point to answer your question is, what's the risk of tariffs? Like, Indian economy is just going to trudge along. It's not dependent. It's not an export-driven economy. In fact, it imports more, raw materials and stuff. So I just think if that's why I said, like, despite the fact these charts sort of have moved together, it's really fundamentally a different story. And so I'm not worried about my India in the age of tariffs. And frankly, I actually like the fact that the tariffs are going to be renegotiated because I think that will give kind of a better base for the next 10 years of growth vis-a-vis the United States.
Okay. All right. Well, fantastic. All right. Any more slides left here, or have we reached the
No,
end?
just, I mean, I think that was basically it, right? So big picture, uh, shallow recession, coined by Adam right here, later in 2025. Tariffs fit into that. Maybe not as in big a way, but they're part of getting to the 3% GDP cut in spending. They're obviously a tax increase, so deficit reduction, I should say, technically. And then we revisited gold and Bitcoin bull markets, just saying, listen, there's some things going on there that you should know about. Bitcoin's higher correlation to the NASDAQ, gold's quite extended. And then growth and semiconductors have retraced enough. So now that their evaluations are much more attractive, which makes sense. And then India and international had a great first quarter, and probably India in particular is attractive after its correction.
All right. Fantastic. I should have asked you this beforehand. So sorry to ask you this on air. But can you send me these slides
Oh yeah, as
to
as
share?
always, we have the Atom version of the slides, which we make available to you and I guess your subscribers or however that goes.
Yeah, exactly. What I'll do, folks, is I'll put it in the summary to this write-up that goes out to all the free Substack subscribers. So, folks, if you want to get these slides, just go sign up for my Substack and go look for the most recent post, which will be my summary of this interview, and you'll see a link there to get the slides, and you can get the full chart deck. All right. Well, look, Jan, these are wonderful. Folks, if you want to see Jan continue to come on quarterly and share his quarterly outlook with him the way that he's been doing the past, I think 3 quarters now,
Yeah.
Jan. Please let us know in the comment section below. I'm going to assume, Jan, that as in previous times I've asked that, the response is a thundering yes. So unless people have a very different opinion, which I don't think they will, I really look forward to seeing you doing this next quarter, and I very much appreciate you doing this. For folks that would like to follow you and your work and vanEck's work between now and your next appearance here, where should they go?
This deck is also on our website, vanEck.com, under Insights, and then I'm on LinkedIn and X. So I do share different kinds of content that I like. So, but these quarterly updates are really helpful, Adam. Thank you for inspiring me to kind of get organized to do these, and hopefully we'll move from the middle of the reckoning where we are now to kind of near the end of the reckoning 3 months from here.
All right. Well, it's such a great pleasure. And when I edit this, I will put up the links to your website and your X handle and stuff on the screen so folks know where to go. But can't thank you enough, my friend, and I'll see you in a quarter. Well, as usual, Jan, this has just been fantastic. Thank you so much for all the effort that you put into these slides and for your willingness to come quarter after quarter and share your outlook with this audience. Folks, please share your appreciation with Jan by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help in navigating your financial wealth through what the road that lies ahead, which looks like it's got a recession of some sort, shallow or other, in its future or likely in its future, I highly recommend that most folks watching this video seek the help of a good professional financial advisor for trying to figure out how to make it through all that. If you've got a good financial advisor who's doing that for you, great. The important thing is that they must take into account and consider all the macro issues that Jan laid out for us here. But if you've got a good advisor who's doing that for you, great, stick with them. If you don't, or you just like a second opinion from one who does meet that criteria, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just fill out the short form at thoughtfulmoney.com. and the advisors will be in touch with you very quickly after that. These consultations are totally free. There's no commitment to work with these firms. It's just a free public service they offer to help as many people as possible position as prudently as possible for what may lie ahead. Jan, this has just been fantastic. Thank you so much, my friend. Really look forward to seeing you back on here again next quarter.
Great. Thank you.